This Chapter 1 describes the two principal ways in which CLNs are structured, the cash flows that occur before and after a credit event, and the risk analysis that you should undertake when comparing an investment in a CLN to a normal bond investment or to a long CDS position. Credit-linked notes, also known as CLNs, are credit derivatives structured to resemble to a great extent a simple bond investments. CLNs are issued either directly by a financial institution that has a high credit rating or via a special purpose vehicle or SPV sponsored by some financial institution. We will refer to the first format as a direct issue CLN and to the second one as an SPV issued CLN. Pros and cons of each will be discussed in detail. A direct issue CLN is a note issued usually by a premier financial institution, let's say JP Morgan, that has a defined maturity and coupon like any other note, and looks and behaves in all other ways just like a regular note, except for one particular feature that is unique to this instrument. This note specifies a reference entity and stipulates that if this reference entity experiences a credit event during the life of the note is extinguished, and the note holder receives from the issuer some defaulted debt obligation of this reference entity instead of getting his principal or any further coupon. To illustrate, we assume that the reference entity is Alcatel, for example, that Alcatel bonds available in the market have a 5-year maturity and a yield of 6%, and that our investor is interested in 3-year exposure to Alcatel, which is not available directly in the bond markets. A diagram is about to appear in front of you in which JP Morgan therefore issues a $100 note with a 3-year maturity and a coupon of 5.5%, with the following important clause regarding the repayment of the bond's principal. First, if no Alcatel credit event occurs during the life of the note holder receives the final coupon plus the original principal at maturity. But, second, if an Alcatel credit event occurs at any time prior to the note's maturity, the note is immediately extinguished and the note holder receives a defaulted bond or loan issued by Alcatel instead of his principal, which Morgan obviously gets to keep. You can readily see that the note is structured to replicate to the greatest degree possible a 3-year investment in Alcatel debt to meet objectives of the investor that cannot be met via a direct investment in the bond market. You can also probably see that some differences exist between this note and a theoretical 3-year bond issued directly by Alcatel, not least of which is the exposure of the note holder to the credit risk of JP Morgan over and above that of Alcatel. We will spend much of this chapter analyzing similarities and differences between the two instruments and proposing a pricing methodology that factors in the usual fundamental and technical considerations which we examined in our module on pricing default swaps. We will assume the note delivered under the security delivered under the credit-linked note following a credit event must be senior unsecured, and we'll compare that to a theoretical 3-year senior unsecured bond issued directly by Alcatel. We should emphasize finally before proceeding that Morgan as issuer is not contractually required to hold any Alcatel debt during the life of the credit-linked note, and may or may not have any credit exposure to Alcatel when it initiates this transaction. If Morgan wishes to be hedged and not to find itself in effect with a short position in Alcatel's credit, Morgan would need to go long Alcatel credit risk, which it can do by either purchasing Alcatel bonds or, more likely, by selling protection on Alcatel in the CDS, or credit default swap, market. From the fundamental risk perspective, the coupon on the CLN should always be higher than that on a theoretical bond issued by Alcatel with the same maturity. There are two principal reasons for this. The first reason, which we discuss now, is that a default under the CLN occurs if either Alcatel, the reference entity, or JP Morgan, the issuer, experiences a credit event. So it is necessarily higher than the risk of default on the theoretical bond issued directly by Alcatel. The mathematics for deriving the default risk of the CLN are relatively simple and are best understood via this diagram and the formula about to appear above it. Since the default probability of the CLN is represented by the total area in white, namely when either Morgan defaults or when Alcatel defaults, and since those two white areas have been shown to overlap here, since there could be some cases in which they both default, it is necessary to subtract the joint default probability of Morgan and Alcatel. Otherwise we would have counted this particular item twice in the total calculation. It is therefore important to determine what we have called the joint default probability of Alcatel and Morgan, which is to say, more precisely, the probability that they both default over a certain time period, since we need to subtract that amount from the rest of the formula. If we make the assumption that Alcatel and JP Morgan are pretty much independent credits, i.e. that they are not very likely to move towards bankruptcy at the same time, and more specifically to go into bankruptcy at the same time, the joint default probability for these two entities becomes simply the multiplication of the individual default probabilities, as you can see here, which means that we can calculate the CLN's default probability given only the individual default probabilities of the issuer and of the reference entity. We have a worksheet labeled PD of CLN, which we have prepared for this purpose, and which will help us develop a number of important observations in a moment. This formula you see here becomes more complex if Alcatel's and Morgan's risk of default are deemed to be positively correlated by any amount. You will come across the corrected formula in Chapter 2. On worksheet PD of CLN, if we assume that the 3-year default probabilities are 1% for Morgan and 5% for Alcatel, we see that their joint default probability is the very small number 0.05%, which makes the CLN default probability based on our earlier formula as much as 5.95%, confirming that the CLN on this basis is riskier than regular Alcatel debt and pushing in principle its coupon higher than Alcatel's unsecured paper, as we had stated initially. It is also clear that the CLN's default risk is far closer to that of Alcatel than to that of JP Morgan, and is not some average of the two, as many people often assume. It is also very critical to understand that the CLN is a very different instrument from an Alcatel bond guaranteed by Morgan, which many inexperienced investors have believed to their detriment. An Alcatel bond guaranteed by Morgan would default only if both Alcatel and Morgan went into default, while our CLN defaults if either Alcatel or Morgan default. The former has a far lower probability of occurring, 0.05%, than the latter, 5.95%, as we have demonstrated. Until quite recently, the great majority of CLNs were issued by very creditworthy banks and brokers with low default probabilities and referred usually to entities with far higher default probabilities. This made it reasonable to view the CLN as almost a proxy for a bond issued directly by the reference entity, since the incremental issuer risk to which the note holder is additionally exposed was so negligible, and therefore it was reasonable to set the coupon under the CLN at a level close to that of regular debt of that same reference entity and having a comparable maturity. Today we live in a very different world, however, in which so many banks and brokers have seen their credit quality decline dramatically, making a CLN like the one we have described a more interesting and complex instrument. Assume, for example, that in today's market, early 2009, both Morgan and Alcatel have a 5% default probability over 3 years. Our worksheet indicates that the CLN's default probability in this cell C9 now rises to 9.75%, making it no longer accurate at all to view the CLN as a proxy for regular Alcatel debt. Indeed, it is almost twice as likely to default, and so should require a far higher coupon than regular Alcatel debt. Conversely, if the issuer were an entity assumed to be more or less risk-free, and so having a 3-year default probability of 0.05%, shall we say, the worksheet shows us that the CLN's default probability would drop to 5.05%, or almost exactly the same as Alcatel's. And yet, in all three instances that we have described, you will have noted that the CLN has a higher risk than Alcatel's regular debt, to a greater or lesser degree, depending on the credit quality of the issuer. The second fundamental reason to expect a higher coupon on the CLN stems from something we discussed previously in our module Introduction to Credit Default Swaps. The fact that following a credit event, the protection buyer, JP Morgan in this case, is permitted to choose among a variety of different bonds or loans of Alcatel which one to deliver to the protection seller, is an option known as the cheapest to deliver option that has value for Morgan and that increases the note holder's risk exposure. If the note holder had bought one particular Alcatel senior unsecured bond, his recovery following a credit event would be the recovery value of that particular bond, while an investor who buys the CLN must assume the risk that the bond delivered to him may be the one with the lowest recovery value among all the issuer's eligible deliverables. This option is difficult to value, but is largest for high-risk reference entities having numerous eligible bonds and loans outstanding with significantly different liquidity, documentation, and other characteristics. Technical factors also make the CLN less attractive than a regular bond and again push its coupon higher. Most probably, the CLN will be part of a relatively small issue and therefore far less liquid than a normal Alcatel bond, although in a few cases CLNs have been issued in amounts of several $100 million. The CLN also will not have been broadly syndicated among a number of investment banks, so the note holder will be more compelled to return to the issuer if he wants to exit his position prior to maturity. Complexity also works against the CLN. You may not find the structure we have described particularly complex, but it is still more difficult to understand than a normal bond and would presumably require more work to get past the note holder's approval committee. The CLN is also less user-friendly than a regular Alcatel bond from both an accounting and regulatory perspective, although we will not discuss these topics in this module. So, with so many disadvantages, what makes the CLN exist at all, you might ask? In our example, the main reason was the simple reality that the note holder's tenor preference was for 3 years, and Alcatel simply had no such debt for him to purchase. There is therefore a sort of convenience benefit that the CLN offers, both with regard to tenor and also sometimes with regard to the desired currency and a couple of other features. The CLN represents for the note holder a more customized investment that better suits his preferences and justifies its existence principally on this basis. The last reason sometimes mentioned for the existence of CLNs is that an investment bank can sometimes structure an issue in a larger size than bonds of the reference entity that are available in the secondary market. So even where the tenor and currency of the CLN match exactly those of the reference entity's bonds, size may explain why an investor must turn to this market for satisfaction instead of the regular bond market. Nonetheless, you should generally assume that a single name CLN is less liquid than its bond equivalent. So how might we go about pricing the CLN? The technical factors we have mentioned are, as always, case-dependent and not easy to price via a mathematical model. But we can develop a simple pricing approach for the CLN by thinking about it from the issuer's perspective. Presumably, one way for Morgan to hedge its exposure under the CLN is to do what appears next on this slide. First, the noteholder's funds at inception are passed on to the Treasury desk, where they earn Morgan's funding rate for the 3-year tenor, say LIBOR plus 5 basis points, under pre-crisis market conditions. And second, Morgan sells protection on Alcatel in the CDS market for a 3-year tenor, earning the 3-year CDS spread S3 for Alcatel. Provided the documentation for the CDS matches fairly precisely the documentation of the CLN, including in particular with regard to the definition of an Alcatel credit event and the eligible deliverables following a credit event, Morgan is completely hedged vis-à-vis the Alcatel credit risk, so could afford to pay, in principle, up to LIBOR plus 5 plus S3 under the CLN. The end result for Morgan, economically, is that it has secured 3-year funding for itself at its normal funding cost. In reality, as with any structured product, Morgan would expect its all-in funding cost under the CLN to come out below what is available to it through normal funding channels, so would shave off a dozen or more basis points from the coupon it offers on the CLN, bringing it down to LIBOR minus 10 plus S3, say. Before proceeding to the second way in which CLNs are sometimes structured, we pause for a moment and emphasize a point of language. By now it should be clear that an investor who is bullish on a particular reference entity and wishes to assume its credit risk can do one of the following 3 things: purchase a bond issued by that reference entity, purchase a CLN issued by another party but linked to this reference entity, or sell protection in the CDS market on that reference entity. All these have similar economic exposures directionally speaking, but potentially quite different accounting and regulatory issues, funding requirements, potential returns, counterparty credit exposures, liquidity, and so on. Yet all 3 positions can be described as long positions in the credit of the reference entity, which benefit to some degree or other if the credit improves and its credit spreads tighten. The reverse of this is that an investor who is bearish on a reference entity's credit, and therefore expects its spreads to widen, or even that the reference entity will default altogether, can do any of the following three things: sell short the bonds of that reference entity, assuming a repo market for those bonds exists; issue a CLN linked to that reference entity; or purchase protection on that reference entity in the CDS market. We would describe any of these positions as short positions in the credit of the reference entity. You should have little difficulty committing this table to memory. What takes some people a little time to get used to is the idea that a purchaser of a CLN is effectively selling protection on the reference entity when they see him clearly purchasing a financial instrument, and also why, if he is selling protection, we describe him as going long the credit. But a moment's reflection should get you very comfortable with the accuracy of these statements, which we will be repeating from time to time. We mentioned at the beginning of this chapter that CLNs can also be structured as SPV issued debt, and to this we now turn. The diagram about to appear here shows the various movements of cash and paper at inception, at maturity, and upon the occurrence of a credit event. We will ignore any profit margin that Morgan requires for structuring this transaction. At inception, we see the three parties: Morgan on the left, the SPV in the middle, and the note holder on the right. On the issue date, the note holder hands over $100 to the SPV and receives in exchange a 3-year CLN that pays a coupon of LIBOR plus S3, say. The SPV on that same day invests the $100 in 3-year AAA paper that yields LIBOR flat, say, or perhaps a little more if the parties are willing to delve into structured finance securities such as credit card ABS or the like that offer a yield premium. Finally, Morgan and the SPV execute the 3-year CDS, under which Morgan must pay S3 annually to the SPV in return for the SPV giving Alcatel credit protection to Morgan per the usual CDS language. Morgan, of course, can turn around and hedge itself by purchasing protection on Alcatel, or can choose to run a naked short position if its traders are bearish on Alcatel. If there is no Alcatel credit event over the next 3 years, the cash flows are simple. Morgan pays S3 to the SPV annually under the CDS. The SPV passes through to the note holder what it receives from Morgan and also from the AAA paper, which adds up to LIBOR plus S3. And then at maturity, the SPV collects the principal from its AAA investment and hands that over to the note holder as well. The SPV has broken even, and the note holder has achieved the promised yield and has recovered his principal. If a credit event occurs at any time during the life of the note, Morgan, of course, would deliver a defaulted senior unsecured Alcatel bond to the SPV under the CDS. The SPV liquidates the AAA paper it holds and pays over the proceeds to Morgan as required under the CDS. And the SPV passes through the defaulted Alcatel bond to the note holder pursuant to the terms of the CLN. If we assume that the AAA paper is still trading at par and various mechanisms are embedded in the transaction to mitigate the risk of price volatility of that paper, Morgan would have achieved exactly the result intended under a CDS following a credit event, namely the recovery of a defaulted bond's par value against delivery of that bond to the protection seller. The SPV would have broken even once again, and finally the note holder would have lost his principal but would hold a defaulted Alcatel bond and can recover the senior unsecured recovery value of that bond, exactly the risk he had expressed a desire to assume. The SPV issued CLN seems to work well, but is undoubtedly more complex than the direct issuance alternative, raising the question once again of why it is needed. The key difference between the two structures from a credit risk perspective is that under the SPV issued CLN, the note holder is taking very limited Morgan credit risk, but takes instead the credit risk of the AAA paper. An insolvency of Morgan would bring about a termination of the transaction, with the AAA assets being sold into the secondary market and their proceeds allocated to the note holder in repayment of his principal. The very limited exposure to Morgan we mentioned just now refers to Morgan's obligation to make payment of the CDS spread to the SPV, which, if not paid, would leave the note holder earning only LIBOR on the CLN rather than LIBOR plus S3. And even this risk can be eliminated by requiring Morgan to pay the CDS spread to the SPV at the beginning of each period rather than at the end, and then further stipulating that a failure to make this upfront payment causes a termination of the transaction. So, for investors that have reached or almost reached their credit limit for Morgan risk, only the SPV structure makes sense. And for Morgan itself, use of the SPV structure reduces its own concerns that its direct issue CLN business might be cannibalizing, as we say, its future access to capital markets for funding, since the CLNs would be using up credit lines available among investors for Morgan credit risk. If you have understood the discussion of default probabilities we conducted so far, you should have little difficulty identifying the correct approach to rating a CLN. Let's suppose JP Morgan, the issuer, is rated AA, while the reference entity Alcatel is rated BBB. Is there a quick and dirty way to predict the credit rating of a CLN issued by Morgan and linked to Alcatel? In the early days of the market for these unusual types of structures, there were those who found it intellectually soothing to approach the rating agency with the argument that since the CLN was issued by a AA entity, its rating should be AA, irrespective of the credit rating of the reference entity. There were those who scoffed, inevitably, but the more emphatic proponents of this view argued further that as long as Morgan was not insolvent, it would always be able to honor the CLN, whether by paying interest and principal before a credit event occurs, or by delivering an Alcatel defaulted bond or loan once the credit event had happened, thereby discharging all its obligations under the CLN. Never mind that a $100 investment had turned into ownership of a defaulted security trading at 30% of par, causing the note holder to lose a very large percentage of his initial investment. The CLN had made a promise and kept it in accordance with the terms of the contract which governed the CLN. Fortunately, sanity prevailed for once, with Moody's and others heralding the absurdity of arguments like these and publishing a paper several years ago in which they characterized these kinds of instruments as a wolf in sheep's clothing, referring presumably to the then AA rated Morgan as the sheep inside whose clothes lies the dreaded BBB wolf Alcatel. More rationally, an approach that quantified the CLN's expected loss, or the related but slightly different expected default probability, came sooner or later to prevail. If we associate with Morgan a AA entity, a 0.5% default probability over 5 years, say, and with Alcatel a BBB, a 2% default probability over the same period of time, the default probability of the note, at worst, would be the sum of these two default probabilities, and at best only slightly higher than the pure Alcatel default probability of 2%, depending, as we will see later, on the default correlation between Morgan and Alcatel. Either way, the CLN's default probability is certain not to be less than Alcatel's, so its credit rating should certainly be capped at Alcatel's. But could it actually be any lower? This would be unlikely under the circumstances we described, since a 2.5% default probability would most probably leave the note in the same ratings band as Alcatel's bonds, i.e. the BBB band, or at worst might push it down by one alphanumeric notch, i.e. to BBB minus. But a CLN issued by a very weak bank in an emerging market, say, whose own rating may be as low as BB, say, could find the sum of the issuer's and the reference entity's default probabilities pulling it down into the next letter band, i.e. the single B letter band in this instance. And when we come to basket CLNs in the next chapter, we will see that it is entirely possible for a CLN issued by a leading bank, but referring to a handful of low investment grade companies to find its default probability if properly calculated, pushing it so low as to pull it into the double B or ultimately single B band as well. This concludes Chapter 1.